This really feels like crypto's year, doesn't it?
Hello, Bitcoiners.
US President Donald Trump is making good on his election promise to make the United States the crypto capital of the planet.
Bitcoin is going to the moon, as we say. It's going to the moon. I want America to be the nation that leads the way, and that's what's going to happen.
Helping to spur a rally in Bitcoin, the world's biggest cryptocurrency, and other digital assets. But what exactly is a crypto asset? Where do meme coins and stable coins fit into all of this? And what do Trump's own crypto activities mean for the sector? Let's try and find out. It's what we do here on Reuters Econ World. Every week, we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. So this week, crypto. I'm your host, Carmel Crimmins, in Dublin. All right, before we get really into this, let's start off with a few definitions. First off, crypto assets are digital assets issued or transferred using blockchain technology. That technology allows crypto assets to be transferred between people without the involvement of a bank. And there are a whole host of assets out there. They range from cryptocurrencies to digital artworks called non-fungible tokens. Bitcoin is the most widely used cryptocurrency. But there are others, including these things called meme coins, which usually start out as an internet joke, and even in the risky world of crypto, are considered highly speculative. But the idea behind Bitcoin and other more established cryptocurrencies is that they can be used to pay for things online. Enthusiasts see them as a form of digital money and an alternative to currencies, like the dollar. A new pro-crypto vibe in DC is moving Bitcoin and other cryptocurrencies into the financial mainstream after years on the margins, when the collapse of cryptocurrency exchange FTX exposed one of the biggest ever financial frauds. But cryptocurrencies remain highly volatile assets. Bitcoin is up around 16% so far this year and hit a record high in May of nearly $112,000. But back in 2022, in the so-called crypto winter, it more than halved in value. That kind of volatility makes it difficult to rely on as a store of value or a medium of exchange, two essential functions of money. So to talk through all of this and where we are right now with crypto, I spoke to John D'Agostino. He's head of institutional strategy at Coinbase, which is the largest publicly traded cryptocurrency exchange. So John, welcome to Reuters Econ World.
Thank you so much for having me, Carmel.
So I want to kick off by asking, were you always a fan of crypto? I ask this because, some of crypto's current fans, I'm thinking in particular about President Trump, they weren't always true believers. So what was your own take in it?
I love that question because normally the question is tell me about your big aha moment,
right?
Which I find a little bit pedantic. So I don't have that big conversion story.
Okay.
Because I was introduced to crypto while I was teaching. I was an adjunct at MIT. And I chose to be an adjunct because I wasn't smart enough to be a tenured professor. And the deal was, I'll give you my time for free if you connect me to the real smart people. And so I embedded myself in the connection science and media science lab and just listened to people. And MIT has been working on blockchain technology for close to 20 years. So it was an established reality within the deep, deep, deep underbelly of MIT where the actual work is being done, that this was valid, this was real, this was sustainable, this was growing, this was important.
Mm-hmm.
So I never had that cynicism, even though I was also on Wall Street, I never had that cynicism sort of corrode my impression of the technology.
Yeah.
And so I had a gradual acceptance from the beginning.
All right, so valid and real, but not really a store of value, right? I mean, Bitcoin is highly volatile. Would you actually recommend it as a safe haven?
I would. And the key is a store of value, not the store of value. So if you talk to anyone who thinks about long-term stores of value, whether they're inflation hedges or mechanisms to pass on to future generation of wealth, there's no good answer, Carmel. There's no perfect hedge against inflation. In fact, I speak to one very, very large sovereign wealth fund, and they talk about the only thing they really can think of doing is picking the best economies in the world and dollar cost averaging into all of their assets. So we start with the ideas. It'd be wonderful if there was one single answer to an inflation hedge and good store value. There is not. So if you think about the stores of value that together have the best possible chance of guarding against inflation and excessive money printing, Bitcoin, without question, is included into that group of assets. The other thing to remember is that volatility is not the same thing as risk. It gets associated with risk, and it's certainly something you have to think about, particularly when you think about the duration of your holding. If I need that money for my day-to-day living expenses, could not agree more. Investing that money into a volatile asset is probably less optimal. But if I'm thinking about a long-term store of value, you would ask yourself, well, what would I rather have? Something that's volatile but tends to go up over time, or something that keeps a stable price range but degrades in value all the time, like the US dollar? So there's no question, if you're advising someone and they need the cash for day-to-day living expenses, money in a checking account, money in cash in a money market account, that's better for them. Mm-hmm. But if we're talking about thinking 5, 10, 15, 20, 30, 40, 50 years in the future, when you do the math, when you screen all of the assets and say, what's the best pool of assets I can invest in? I mean, there's real estate, there's certain types of government bonds. Bitcoin plays a role there. The nice thing about crypto is people can educate themselves by working within it. Anyone with a computer or a phone can participate in the crypto ecosystem. So it's a lot easier to learn by doing in crypto than it is in traditional finance. And if you meet someone in a bar who says they're in crypto, they will not shut up.
Run a mile.
So just plant yourself there and have a great conversation.
All joking aside, though, there are a whole universe of crypto assets out there. So from the more established cryptocurrencies like Bitcoin to things like meme coins.
I think of them as digital collectibles. And if people want to engage in the collecting of collectibles, more power to them. And there's a very, very low cost of entry to doing that. Think of it like Etsy. But instead of having to create the thing, you could magically create it in 10 seconds with almost no money. Think about what Etsy would turn into 1 billion projects, right? If you didn't need it, if it was easy to crochet, right? If and it was free, almost free to crochet, everyone would be posting things to Etsy. So people, and some people want to be a part of that because of culture, and they have all their different reasons. But there's billions of them because there's no real barrier to entry to create one.
They're definitely volatile and at the riskier end of the spectrum.
Carmel, I like to fish.
Right.
I like to fish and I don't catch anything. So you can make an argument that the money I spend on fishing is completely wasted and nonsensical. So I try not to judge people. People want to buy something because they believe it helps them belong to a community. I try not to be judgmental of that. Everybody has different ways of spending their disposable income.
So President Trump has a meme coin, and his family's crypto venture has a stable coin too, which we'll get into stablecoins later in the pod. So there's no doubt that his administration has helped crypto move into the mainstream. But is Trump both a blessing and a curse for the industry because his involvement with the sector raises these questions about conflicts of interest?
So, I mean, I think just stepping back, I think if you just look at the performance of the industry during this period, the answer would just, I think, mathematically be no. I mean, meaning the industry has done extraordinarily well under these conditions. So I think having a president, and then perhaps even more importantly, having a fresh administration, both elected and appointed officials that are pro-innovation, that are pro-technology, that are willing to listen, that aren't holding on to 75-year-old infrastructure as being sacrosanct. That is far more, on the scale of what's good and bad, that's far more weighing down on the good side than anything on the bad side. Look, I think as a society, we have to kind of decide what we want our elected officials to do. We haven't really decided what we want them to do for stock trading yet. So I think we're kind of figuring this all out. But net, having a president and administration that's supportive of this technology has absolutely been a benefit.
It's not just the Trump administration that's pro-crypto. More members of Congress are now too. And Coinbase played a role in that, right? In the most recent congressional elections, you donated to a lot of races.
Well, I think technically the PACs donated, but yeah, so Coinbase is a part of that effort. There's no question.
Yeah.
There's no question. I mean, look, I never understood why the anti-crypto politicians were on board with being anti-crypto. I don't know a single politician that picked up a single vote being anti-crypto. My mother doesn't understand crypto. She doesn't. She doesn't get it, but she's not voting anti-crypto. There's many, many more important things to worry about.
Right.
But there are 52 million Americans that are adamantly believe in crypto, not just as an asset class, but as a new way of organizing trust and information, and they believe in financial freedom. So you have 52 million Americans who are passionate about it. You have, I think, 0 Americans or close to 0, even if they answer a polling question, say, yeah, I don't really understand that crypto stuff, I have a slightly negative view of it, they're not voting on that issue. So I never understood the anti-crypto alignment. So absolutely, crypto played a big role in these elections because younger people voted on that issue. There are 52 million Americans, roughly, who own crypto and participate in the ecosystem.
Yeah.
Here's a really fascinating data point. There are roughly 52 million Americans who've purchased stock. Now, I'm not talking about people who own stock in their pension fund. That's way higher. Actively went on an E-Trade or somewhere and clicked and bought a share of stock. So the same amount of Americans have made a conscious decision to invest in our equity capital markets that have chosen to invest in crypto. That's a powerful voting bloc. So it did play a big role, but it was because people are passionate about this issue. And no one is as passionate against it. That's the part that I think politicians now understand.
The best real-world example of crypto's move into the mainstream is what's happening right now with stablecoins. They're a type of cryptocurrency meant to have a steady value because they're tied to a real-world asset, usually the US dollar. In one way, stablecoins have already entered the mainstream. They've replaced Bitcoin as the cryptocurrency of choice among cybercriminals. That's according to a recent report from data firm Chainalysis. But they're also the focus for a major piece of legislation in Congress that, if passed, could turbocharge their use as a form of digital payment. Critics say they could also be a source of financial instability. John and I spoke about them.
I mean, they're vitally important because they're in some ways, they're the onboarding ramp. So a lot of people who are in meme coin culture will say, oh, meme coins are good because they're an onboarding ramp to learning about crypto.
Right.
And I buy into that argument to some degree. But stable coins, without question, are an onboarding ramp both for individuals, institutions, governments, municipal entities. They're very, very efficient mechanisms for cross-border payments, for sending remittances in theory. Like the notion you should spend anywhere from 4 to 15% to send money home to your family from a foreign country is horrible in my view. So they're very, very powerful instruments that can provide a base layer for not just entry into the crypto ecosystem, but using crypto as a core fundamental unit of economic value. And so you can look at the adoption rates and how they've skyrocketed across the globe. And it's very, very easy to say that they're a essential element of crypto adoption over the long term.
So in the bill before Congress, stablecoins have to be fully backed by low-risk assets like bank deposits and treasury bills. But what if a stablecoin issuer gets into trouble and has to liquidate its reserves, like its bank deposits or its treasury bills? Couldn't that trigger volatility? Like some of these stablecoin issuers are big holders of treasury bills.
So I kind of struggle with that concern because I understand if these were unregulated, unregistered, rogue stablecoins that were not actually backed one-to-one. That I completely understand. But when we talk about a run on the bank, we're not talking about people selling assets that are one-to-one backed. A run on the bank means I'm selling assets that are 10-to-1 levered. That's what causes financial instability. Anyone can sell T-bills. There can be when you say a run on T-bills, you mean China could sell the hell out of our government bonds tomorrow. So introducing stablecoin layer on top of that are safe and backed but one-to-one by these assets doesn't decrease or increase the probability of buys or sells. It just makes the system much, much more efficient. So I struggle whenever I hear people say that. I think what they're trying to say is you're worried that we'll have stablecoins that are frauds. You're worried about stablecoins that aren't actually backed or that are levered when they say they're unlevered.
No, I think for me
that does scare me.
No, for me it's more that financial markets get linked in all sorts of ways that sometimes you don't realize until you're right in the thick of it. Like you think of the financial crisis, and it's that sort of scenario, right?
Sure. In a risk-off environment, people are going to sell everything. Stablecoins are not immune to that basic market dynamic. So yeah, it doesn't raise the risk. In fact, I'd argue people panic and sell when they're scared of illiquidity. By improving liquidity, by decreasing the friction associated with transactions, I think you actually increase people's comfort level. But make no mistake, Carmel, if they're going to panic, they're going to panic and say, blockchain is no panacea against human failure. So if people are going to panic, they're going to sell everything, including gold, including treasuries, including the dollar. So that doesn't make us immune, but it doesn't increase the risk. And then no one's ever proven to me how it increases the risk.
I suppose it's the perception that even the name itself, stablecoin, it's like, you mentioned money market funds earlier on. I think there was a perception before that they were almost like deposits, like they weren't.
Yep.
That they weren't guaranteed. And so there's that kind of realization after the fact, and
Yeah.
And again, I suppose it goes back, it's the branding.
That's fair.
Right? It's how you present these to the public.
That's fair.
Writ large. That matters.
Yep. Look, I think if you just poll the average person and say, how do you feel about financial derivatives? Even if they don't even know what that word means, more than half are just kind of going to recoil and say, that this sounds complex. It sounds like the kind of stuff that...
Absolutely.
So we blame these things for market crash, but what causes market crashes are human panic. So I couldn't agree more. And I'm not a branding person, but I think that's a fair statement that maybe we could do better in sort of naming these instruments. But again, decreasing the friction associated with a transaction, which is ultimately what blockchain does, ultimately what stablecoins do, decreasing the friction associated with a transaction increases the probability of stability because people feel more comfortable they can get out.
So, John, Coinbase has had quite the year already, right? Like, you joined the S&P 500. That's a big stamp of investor approval. But you also experienced a hack of your customer data, and that's expected to cost the company around $400 million. Reading online, I saw some people commenting that this kind of thing, wouldn't have happened if everyone was anonymous. It sort of shows the tension you face as a centralized operator, as an intermediary in a world that traditionally wants everything decentralized, right?
It's a wonderful question, and you are 100% right. There's a certain tension, I think, naturally that exists between centralized and decentralized. First of all, not to be nitpicky, I know that's the common. We talked about how naming and branding is so important. It really wasn't a hack. It was individuals, people were bribed, a rogue employee situation. I know that's a nuance, but I do think it's an important distinction to make. I would have loved it if Coinbase was the only large firm in the world to never be infiltrated in this way, and it was for a very long time. But as we all know, all of us get those letters from every company in the world. I've gotten about 10 this year. These have become unfortunately ubiquitous, and I'm proud of the way the company responded. But to your point about this tension between centralization and decentralization, it's a really, really cool concept because obviously I work for a centralized firm in an asset class that had its origins in decentralization. Now, Coinbase supports decentralization. We have self-hosted wallets, we have peer-to-peer transactions. So I think Brian Armstrong and Coinbase are big believers that decentralization is an essential characteristic for crypto. There's no question. We fight in Washington to maintain the ability to self-store, to self-custody, even though we have a custody business, right? So we fight against our interests to some degree because we believe in that. But I think if you just think about human behavior, it's likely that centralized, trusted counterparties will remain important. And the analogy I give everyone is the average American's net worth, inclusive of their home, which isn't really cash, but let's be generous, is about $216,000, inclusive of their home. The average, not the median, the mean, obviously.
Yep.
You can take that amount of money out of the bank. It represents a brick of cash about 16 inches by 9 inches, and it weighs about 9 pounds. That's very easy to store. So almost every American could self-custody today if they wanted to, but we don't for lots of personal reasons. So I think we will always need trusted, centralized custodians and counterparties. But I want to be very clear. The characteristics of decentralization and self-sovereignty are vital to crypto. And there are also concepts that Coinbase, even though we are a centralized entity, support robustly.
Where do you see crypto going? So at the end of this year, what new developments do you expect to see in the crypto sector?
I think the big things are tax and regulation. So I'm 99% confident we'll see some great stuff coming out of Washington on the regulatory and legal and law side. It starts with law and then it filters down to regulation and rules. And then we have all the pieces. So in the next 6 months, I see a dramatic shift on the regulatory side. I'm hopeful that carries over to the tax side because we have some problems around the way the IRS treats crypto. And if those two pieces fall into place in this year, then we are very, very primed for all of that great technology that moved offshore during the last 7 years to come back here.
You worry, though, because there will be losses, right? People will put money in and they will lose money. Do you worry about potential backlash if there are big losses, if people do suffer big losses from crypto?
Sure. Yeah, no, sure. I think anytime people pile into any trade and there's sort of a mean reversion, and most assets mean revert, everything can't go up, just mathematically, it can't go up 10,000% a year.
But also with the regulatory changes that the industry wants to see, right? Like the idea that some crypto assets aren't securities and so fall outside SEC rules.
So look, I'm less worried about value losses occur in every asset class. They don't necessarily lead to a shift in sentiment or regulatory change. Value losses as a result of fraud that indicate sort of like an essential problem in the market infrastructure. They are problematic. So I would be worried if we had another FTX or something like that.
Yeah.
I'm encouraged by the fact, two things. One is every time we go through a cycle, the jokers kind of peel off. And so where I am now relative to my peer, I'm prouder of my peer group now than I was, say, 10 years ago. So that's a good thing. I look around and I see lots of like credible adults in the room. So that's one thing. The laws are really, really going to help because clear laws produce better players.
A big thank you to John for his time. You can read all about the latest developments in crypto on Reuters.com and the Reuters app. If you're interested in understanding more about markets and the economy, check out Reuters Open Interest, a new source for global financial commentary. You can catch it on Reuters.com and the Reuters app. Sound design, music composition, and engineering on this episode was by Josh Summer and Alex Summer. Our podcast team includes Kim Vanell, Tara Oakes, Gail Issa, Christopher Walljasper, Jonah Green, David Spencer, and Sharon Reich Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.